Welcome to the Armchair Trader podcast. And today we have Stephen Yiu in the studio, Managing Partner and Chief Investment Officer at the Blue Whale Growth Fund, a fund which is widely followed by the investor community. Welcome to the podcast, Stephen.
Thank you, Stuart.
So firstly, for those listeners who haven't heard of Blue Whale Growth Fund, can you give us a quick rundown on the fund itself and what its objectives are?
Yeah, so the Blue Whale Growth Fund, we started back in September 17, and we run a single strategy, basically investing into the best of 25 to 35 stock globally. And the investment philosophy is very simple, that we want to invest into high quality businesses at an attractive price. And we do all the research in-house. We don't speak to any sell-side analysts or read their research. So we think with a team of 5 on our side that we should be able to do quite a lot of work in terms of the company that we invest into.
Gotcha. And before you were doing this job, what sort of roles were you involved in previously? I know you were at Nevsky, for example, the hedge fund, which I'm familiar with from back in the day.
Yeah, so I started 20 years ago, started my career at Hargreaves Lansdown. That's where I met Peter Hargreaves, who is also the co-founder of Blue Whale Capital. And then I joined Team Steer at New Star Asset Management and also Artemis. And then at the time, we were running both a long-only UK fund and also a pan-European long-short hedge fund. Then, later on, I joined Martin Taylor at Nevsky Capital for about 2 years, and I was very much involved looking at the global companies at the time.
Great. Now, getting down to the investment world, you have written recently about how you feel, and this is something I agree with as well, that there's been a real shift in the market. Previously, we were in the post-financial crisis era, so the post-2008 era, which really redefined financial markets. Now you're arguing that post-pandemic, the world has changed again. What sort of impact does that have for investors, both at your level and also private investors, and how should that make them change their habits?
Yeah, I think that is probably the most important point that we want to address today. Is if based on our approach, we invest into companies from a bottom-up perspective. Of course, people can take a top-down view on certain issues. But if you look at what have happened over the last 10, 15 years, we have an era of cheap money, cheap goods, and low interest rate for a very long period of time. And at the time, of course, if you invest into companies that would benefit in terms of selling more goods to consumers, people are spending more money because they have more money in their pocket, and interest rate being quite low, which means that I think typically the equity market goes up when interest rate is quite low, then it's all quite straightforward, or it's a lot easier to make money from the market. But then if you look at what happened during the pandemic, you already would have seen that there was a massive differential in terms of companies that benefited from pandemic, like the pandemic winners, like the FAANGs at the time. And then equally, when you have the traditional businesses, because of the lockdown, that they did suffer quite a lot during the pandemic. But I think what we are saying now is in the next 5 years, we are going into a new world, which is post-pandemic, that when you follow what's going on in the world now, we do have quite a high level of uncertainties in terms of geopolitics developments in both Asia Pacific, in the Middle East, and of course we still have a war going on in Ukraine. And at the same time, on the back of that, you have many companies trying to de-risk away from, let's say, Taiwan or maybe China. They're trying to reshore some of the activities back to the US or maybe in Mexico. And at the same time, that we do think that inflation is going to come down from very high rate, let's say 10%, but it's still going to settle down at a higher level than before. So it's unlikely that we go back to the 2% regime. It's maybe more likely that we would stay at about maybe 4% regime. So what it means is interest rate is going to remain higher for longer. So when you put all this together, what you want to do as an investor is you want to find companies that either would benefit from some of these trends, which I'm sure we can talk about later, or you want to avoid companies that will be impacted by some of this trend going forward. So you don't want to, for example, you don't want to invest into highly indebted businesses because if they need to refinance at a high rate in the next couple of years, that profit is going to suffer. And at the same time, you probably don't want to invest into a company that have over exposure to certain dynamics that might be working in the opposite direction going forward as well.
And when you're looking, you're obviously a bottom up stock picker. What are you looking for a company? What, the ideal company that someone puts in your Christmas stocking? Um, what characteristics would that company have? I know it probably doesn't exist, but what sort of things are you looking for there?
Yeah, so if you look at our top 10 holdings, which they are all very large company to start with, would be that we like company that have a very strong competitive positioning. So in terms of the market share they have in the product or services they sell, and one way of assessing that is to look at the switching cost. So, for example, for people who work in office, like most of us will be using Office 365, which is a product by Microsoft. And if you think about the switching cost of us moving on to another, let's say Word or Outlook or email system, let's say Google G Suite, it's almost impossible to do that. Like, so despite the fact that Microsoft have increased prices by about 15 to 20% over the last 18 months, we are still staying within the same ecosystem. But then in contrast, for some other companies, such as, let's say, Netflix or Zoom, that the switching costs for consumers or users are pretty low. So that, let's say, if our consumer pocket is now being squeezed by inflation, by high level of interest rate, and then there's only a limited amount of time that we have to watch new content, we could easily switch off our subscription to Netflix for a couple of months and go to Now TV, go to Disney Plus, and then come back to Netflix. So what it means is it does have implication about their pricing power. If they decided to raise a lot of prices, consumer might be voting with their feet that they would go somewhere else because their lock-in or the switching cost is quite low. So that is very important. And of course, then on top of that, you want to invest in your company with an exceptional management team that they are quite incentivized to do quite well. And last but not least, which is going back to the point that I mentioned earlier, is you in the new regime, you want to invest in your companies that their free cash flow delivery over the next coming years is going to be a lot more certain or less uncertain because of the geopolitics environment. So hopefully they're going to benefit from some of these dynamics, or at least they're not going to be impacted. So what we are avoiding, on the other hand, is consumer-facing companies. And you can see why consumer-facing companies, whether they're tech or not tech, is going to face a bigger headwinds in the next couple of years compared to the last 5 years.
Understood. And going back to Microsoft, what is it about Microsoft other than obviously that competitive edge that keeps it in your portfolio?
Yeah, I think what's been quite interesting about Microsoft, obviously, is already one of, I mean, the second biggest company in the world. And I recall there was a time that maybe it was about probably 18 months ago that Microsoft reached about maybe $1.5 trillion. And at the time, I think there was some commentator suggesting is as big as the UK stock market, which is about the same size or something similar. And and how big can it become? Like why how big can a company to become to grow more on top of what they have already achieved? But when you look at the innovation from Microsoft, which Teams would be a product. I'm sure most of us will be using Teams over the last couple of years to interact with our colleagues, to do conference calls, and do a lot of things that we used to probably do in person, and now we can do it virtually. Is that product was developed in house? And when you look at the number of people who's using Teams now, is like you talk about like 200 million people using Teams actively. And at the same time, if we are thinking about AI developments, that they have made a very big investment into ChatGPT. So now going forward, Bing.com, which is their search engine that is more of a competitor, a very small competitor to Google search, they would be able to have the ChatGPT capability to do that. And then going forward as well, which they have recently made an announcement, is they are going to have the Copilot capability, which is it's like an AI within the Office 365 domain that you can basically type in command to say, can you create me this presentation with all these pointers? And then our presentation could be created for you in seconds. So they have a lot of innovation going on. And then if you look at the management team in the last 10 years, that they have managed to make the transition into cloud or subscription quite successfully. And at the same time, the innovation continues. And when you put all this together, then the question is like, how long can this continue? Is anyone else going to come in to disrupt their business model, to take market share from them? At the moment, it's very difficult to see that just because how dominant they are in terms of, especially within the enterprise domain.
The tech sector obviously is something that a lot of investors are really interested in, and it's amongst our readers their favored sector. But you've lost enthusiasm for the FAANGs. You've said in the past. What is it? What is it about the FAANGs that are looking less attractive now to you?
Yeah, we were just talking about earlier that in this new regime that it doesn't matter what you do, you probably want to avoid consumer facing companies. So whether they're technology company or not technology company. The reason for that is our discretionary spending or our pocket is going to remain squeezed by inflation, by food prices, energy bills, at the same time, high level of interest rate. If you have a mortgage and it's going to come, especially in the UK, that the typical mortgage period is probably 2 to 3 years. So if you bought a house 2 years ago, you probably would need to renew next year or so at a much higher rate so that we have less money to spend on a discretionary basis. And then when you look at the FANGs company, most of these companies are consumer facing to start with, like Amazon, Google, in terms of their digital advertising revenue stream, like even Apple in a way that is consumer facing. Of course, I mean, you can argue that Apple may be on a different league because people seem to be quite happy to pay a high price for the next iPhone, and it is announced this new lens yesterday that is going to be quite expensive product. And at the same time, the other thing that we have tried to reposition our fund is if we were to pick a region, that we do prefer North America as a region, so that we want to have more exposure to the American economy or American consumers, if that is the one that we want to pay. But when you look at the FANGs company, they are all global businesses. So on average, about 50% of their money or revenue is coming from outside of North America. And of course, we're sitting here in Europe, in UK. We do know that inflation is killing us a lot more than some other places. And so basically, what the FANGs is going to experience in the next couple of years, not that they can't do well, but they are going to face a lot more headwinds. One is consumer spending, discretionary spending. At the same time, is the global development outside North America.
Yeah, and staying on the tech theme, the artificial intelligence story you've touched on it already in connection with Microsoft. We hear about it every day at the moment. I'm in the investment world as well. In fact, everyone's talking about it right now. Is that a story that's being overbought in the market? Are people attributing too much importance to it right now? Should we all just be calming down, or is this really going to be a big game changer for the investment market and for the global economy more generally?
Yeah, we do think is a game changer in terms of what we are going to experience in the next couple of years compared to the last decade. And the reason the rationale behind this was mostly purely down to the rise of ChatGPT, like how ChatGPT has come into our day to day. Because if you think about AI development over the last, let's say, 10, 20 years, it's not new. Like everyone knows that there's a bit of AI going on. If you go onto YouTube, that would be video recommended to you. You go onto TikTok, that would be very clever algorithm based on your interest, like certain video get recommended to you. You go onto Facebook, like you will see certain news articles that get popped onto your screen, which would be very different to someone else Facebook account. A lot of these have been done by AI in the past. So AI is not new to the software developers, to the scientists. I'm sure that there's a lot of biotech engineers trying to use AI to come up with new drugs or molecules and all this stuff. But what have changed in the last 6 months is the how ChatGPT have given us as consumer, the day-to-day layman, a glimpse of what is possible. And of course, we probably would think that it's going to come in time. What we didn't know is going to come so quickly, which is basically now. Everyone, like if you look at the user base within ChatGPT, you're talking about like probably 100 to 200 million people already have used that capability, and it's still at a very early stage of what is possible going forward. So we think that have changed, and some people would actually suggest that the arrival of ChatGPT is similar to the iPhone moment, but more in the AI world, so that now everyone can have a bit of interaction with AI. And the other thing which is important to note is ChatGPT is only the beginning of this. Like in a couple of years' time, I would not be surprised if no one ever then talk about ChatGPT. Just a bit similar to Google was the 7 or 8 search engine that was created, and we didn't even remember what's the other 6 or 7 search engine before Google. Now we only talk about Google. So ChatGPT could be one of those, could be a fate. But what is yet to come is there's going to be many more equivalent of ChatGPT. I'm sure Microsoft would have their version, Amazon would have their version, Apple is going to come up with their own. I think Elon Musk is trying to work something out for their Twitter audience as well. So there's going to be many more of these equivalent ChatGPT, which is generative AI, and it's going to change a lot of things that we do going forward. And I think the implication of that could be similar to when we have the industrialization in factories. So if you go into a factory now, you don't see many people on the floor. You see many robotic arms trying to put a car together. You go to a Tesla factory, you see all these things being automated. I think what haven't taken place, which is going to come quite dramatically, is in the white collar worker space, like in the office environment, that you can see that a lot of these jobs that people do on a very low level could be automated, could be done by the AI. It doesn't need a person to put together a PowerPoint presentation. You can easily just ask the AI to do it for you. And of course, you still have the human touch to maybe fine tune certain wording of how you want it to be presented. But the grunt work could be done by AI. So theoretically, it's going to solve certain issues that in the next couple of years we would probably have less labor shortages, and you basically would value experiences more. Like you want to hire people with a lot of experience to add value on top of what is already achieved by AI. But if you're just starting up your career, that you are told to, okay, let's put this stack together, let's go through all this like data point together. I mean, that could be done by AI.
No, I see what you mean. It's obviously going to have a huge impact. I wanted to go back to something else we mentioned already. You've touched on it. Geopolitical risks. If we're talking about a new era of investment, that seems to be dominating a lot of investors' worries at the moment. It's causing a lot of wealthy investors to almost stay out of the market and sit in cash. The Russian invasion of Ukraine shook a lot of people up. When you're looking at a global portfolio, how do you allow for that? I mean, I know you've mentioned already on this podcast that you are looking at companies in North America that have less international exposure. Do you have any other considerations you bring to bear when you're looking at stocks? And do you see these geopolitical risks as something that's here to stay?
We do think that the geopolitical risk is here to stay. It's probably going to get worse before it get better. and this could last for the next 5 to 10 years. I think we're just literally in this new regime when you look at what Putin's doing in Europe and what Xi could be doing in Asia or to Taiwan in the next couple of years. That is not going to go away anytime soon. So this is completely a new regime. So what we can do as investor is two things that we can do. The first layer is try to invest into companies that could be exposed to certain uncorrelated drivers to the rest of what's going on in the world. So AI being one that you can see that AI is going to get adopted quite quickly as we can. And at the same time, if you are the company, let's say NVIDIA, which is the largest position that we have in the fund to get exposure to this, is they're selling their mission critical equipments to build out the infrastructure, which is the GPU that they have, in order for AI application to be run on top. So that could continue despite that, yes, geopolitics uncertainty is here to stay. So that remain quite a big part of our fund. And of course, I mean, we have talked about Microsoft and some other companies, and that would be the same for them as well. But equally, there are certain companies or sectors that could benefit from some of this geopolitics uncertainty, which we have equally make certain investment into. So a couple of those things like the reshoring opportunities in the US, which is purely on the back of company want to de-risk away from, let's say, China, or try to bring certain production capability back to the US. So we have invested into two US railroads. And so if we expect more things is going to be produced domestically, then the railroads are going to benefit. And of course, it's US centric or North America centric to start with. So they are less exposed to geopolitical risk. And then secondly, we also have invested into an energy company, which is fairly new to us last year, that this company that we had operate in a very stable region, which is in Canada, Canadian natural resources. But if you think about what geopolitics uncertainty means, even though that we don't think we can forecast the oil price to whatever level it's going to be, but you can easily come up with a scenario that if there's more conflicts going on, the oil price is going to go to a high level, or being at least well supported at the current level, despite that a recession is yet to come. Like everyone talk about recession. But when you follow the energy market, let's say look at Saudi Arabia, they are trying to basically cut production to support the oil price. That's part of the same narrative. It's about geopolitics uncertainty. It's about getting the price to stay at a certain level. And then, of course, if you operate in a regime or in a region that's quite safe or quite sound, at the same time, the cost of production per barrel of oil is quite low, which for this company is sub $30 and $40. Then they're going to make a lot more money in the next couple of years if oil price, just maybe assuming that it's going to stay at 70 or 80, not going up to 100. So that is another one. And the last one, which is probably more controversial because you can read it both ways, but then we would think that is more positive, net positive than negative, is semiconductors equipment companies. So you would have followed there's a lot of headline going on in the last 6 months that the US trying to restrict certain technology going into China. So that if you're producing, so if the company is producing semiconductor equipment company, you would be barred to sell your equipment to China because they want to probably stop China advancement in terms of the semiconductors capability. But then equally on the back of that is we have the CHIPS Act in the US, and then we have the equivalent of that in Europe. And at the moment, on the back of this geopolitics uncertainty, or trying to stop China from advancing that capability, is there are $300 billion committed to build new foundries in the Western world. So that's going to go into the US, going to Germany, going to France. I think even UK is talking about building a new foundry. I think we might be a bit short of money to do that because it's quite expensive. But then how have all this come about is because people are worried about Taiwan. Like at the moment, majority of the high-end semiconductors produced in Taiwan. If one day Taiwan ended up to no longer be independent, then we need to have that capability. So how all this commitment come about from the government perspective was the byproduct of the geopolitics uncertainty. So they would be selling many more of their equipment in the next few years compared to the last 10 years, just because we want to replicate what Taiwan has in terms of capability.
And just finally, when you're looking at companies, are you applying any considerations in terms of the actual governance of the company and their social environmental record? And do you think that a good record in these areas can be a contributor to positive performance? And have you ever looked at a company and said, look, we're just not happy with what these guys are doing right now. Their environmental record is poor, or we've got a few governance red flags have been shown. Is that a big issue for you guys?
So the way that we have done it, obviously, the fund is not a ESG fund. So we are a global fund. We don't have a restriction in terms of what we can do and not do. But the way that we assess quality of a company is we deem ESG as a risk factor to the business in terms of the return on invested capital profile of this company. So what it means if you are not doing the right thing in terms of either doing it to the environment or doing it on the social space or even the governance, is going to increase the cost of capital for the company, or it means that the regulator is going to come after you a lot more. You have the more activists coming after you, like trying to probably make changes or disrupt your business and all this stuff. So that is not like if you operate in a way that you don't really care about what's going on in the world as a company, then it's not good for shareholders. I think we would expect any high quality businesses that we invested into, let's say Microsoft or Nvidia, would be doing the right thing, or even Master and Visa. I mean, they would have the way of approaching ESG, and it's just one of those things. Like at the moment, it's quite a heated topic because like you would have people arguing of different camps arguing, oh, we need to go all in. Like we only look at companies that are actively engaging with the ESG conversation, and then there's certain investor would say, okay, we just want to see a progression in terms of that development. That you have certain investors say, I don't really care how this is going about. Let's invest in anything. But in probably, I don't know, maybe 10, 20 years time, that ESG conversation is probably going to disappear because firstly, only company that would be actively engaging or positively engaging with this narrative would remain high quality, or you have company that doesn't really care. They're no longer part of the market. And so from our perspective, we just want to invest into companies that are on the right side of the camp and not on the wrong side. And that's what we're doing in terms of how we assess the ESG factors.
Well, thank you very much indeed for your time this morning, Stephen. That's been really informative, and thank you for coming on the podcast today. You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.